Okay guys, so in today's video we are going to discuss IAS.1, which is International Accounting Standard number 1. So I did some short summary so that you can understand a better. This is the introduction video, so please make sure that after you understand this introduction video, go and watch other videos that I did, examples and other transactions that are related to this standard. However, you need to understand some basic before you go into a question so that you will know that this standard is about this and this and that. Okay, then let's look at these notes that I provided. So number 1, we are going to discuss about objective of this standard. Okay, IAS.1 set out a general principle and requirements for presentation of financial statement, ensuring consistency and comparability. The reason why we have this standard, guys, is because this standard must guide us that when we prepare income statement, we have to start from sales, cost of sales, gross profit, then we go to other income, expenses, then we go to operating profit, and so on and so on. Because if there was no this standard, guys, some of people, when they prepare income statement, they were going to start from expenses. Then from there, they record sales. Then from there, they recorded other income. And some people, they were going to even include an asset under income statement if we didn't have this standard. Why? Because if we don't have a structure, or if you don't know the skeleton, what are you going to record under a statement that you are going to prepare? You are going to complicate everything. So this is why we have International Accounting Standard, a presentation of financial statement. Okay, number 2, a fair presentation. Financial statement should be present fairly, the financial position, a performance and cash flow of the entity, and should comply with international financial reporting standard, which is IFRS. When they said a fair presentation, guys, simply means that you need to follow accounting standard when you prepare this financial statement. For example, guys, we have a balance sheet or financial position. Remember, financial statements are going to be used by someone. Let's say a company needs to borrow a cash from the bank. They are going to look to our financial statement, obvious. But if we didn't present them fairly, you can find that a balance sheet that we prepare is even wrong. Maybe we added some assets. We just write we have assets of 4 million, while we know very well that we don't have. Just for bank to do what? To approve. Obvious, bank is going to approve a loan, maybe a loan of 500,000, because they know that if you don't pay, they're going to take some of the assets. Okay, so it must be fairly presented so that at least the other users, even the investors, guys, someone who want to invest into a company is going to check, is this company making a profit? Because you can't just invest your money into a company that is not even making a profit. You are going to lose your money. So this statement must be presented very fair and square. Okay, then number 3, components of financial statement. Financial statement consists of balance sheet, income statement, statement of change in equity, statement of cash flow, and other related notes. Okay, so this one actually is what I was saying, that guys, when you present your financial statement, if you are talking about a balance sheet, we have to see assets, equity, we have to see liability. When we see income statement, we have to see both sales, other incomes, expenses, and so on and so on. Cash flow statement, we have to see only cash item. Okay, then number 4, going concept or going concern assumption. Financial statements are prepared under assumption that the entity will continue operating for the future and unless management intend to liquidate or stop a trading. So a going concern assumption, remember when we prepare our income statement, balance sheet, or all those financial statements, we have to state a going concern of the entity. We have to state whether this company is still going to operate in the future, or the company is going to liquidate or is going to stop trading. We have to stipulate that. Okay, sometimes you can see it through a profit that we are making. You can see it through the assets that we are losing. If we no longer have assets to produce the profit that we are making a big loss. Our cash flow, everything is outflow. We are not receiving any cash. You can assume that there is no going concern into this business because there is no cash that is going to help us to operate, which simply means that a going concern is very important. We have to do assumption after preparing those financial statement. Okay, it must be there to be fair, to fairly presented. Okay, then number 5, we have accrual basis of accounting. Financial statement should be prepared on the accrual basis, recognizing the transaction and event when they occur or not when the cash received or paid. Okay, accrual basis, guys, this is the principle of accounting that says that it does not matter whether you receive cash or not, you must record the transaction. For example, if we purchase equipment, but on credit, simply means that we didn't pay any cash, but equipment is there into our business. We have received the equipment, but we are owing someone. This kind of transaction must be recorded. It does not matter whether the cash has not been paid. We have to do what? We have to record. Like if our customer purchase on credit, the goods went out, okay? The goods went out to customer, but we have not yet received cash because it's credit. That kind of transaction must be recorded in terms of what? Accrual basis. It does not matter whether the cash is received or not, as long as transaction is okay. Okay. Then number 6, materiality and aggregation. Information should be presented separately if it is material or significant in nature. Immaterial item can be aggregated to provide useful information. Okay, when we are talking about materiality, guys, as a company, each and every company have different materiality. Materiality, where simple means that, let's say maybe for example, I can say that my company have set materiality of 500. In other words, if there is any missing amount or there is any shortage that happen, which is 500 or more, we need to do a serious investigation. How did this happen? Because this amount is material, it's matter. But if 400 get lost, this amount will be immaterial. It's not necessary, which means that there is no further investigation that needs to be done. Materiality is like we're saying that this is important, this is not important. Okay. Then number 7, consistency, comparability, presentation and classification of items should be consistent over time for entity and comparable among different entities within the same industry. Consistency and comparability. For example, guys, if we are applying standard IAS.1 of inventory, and we are saying that we chose to calculate our inventory, to value our inventory using FIFO method. When we compare FIFO method of our company and other business that are related to us, it must be the same. The procedure must be the same. That's what we call it, consistency and comparability. Okay, if you are using weighted average method, we must use the same formula. Someone must not use the other formula which is very different with us while we are using the same method. It must be the same. Okay, even if maybe for example formula can give you the same answer but the different style is still fine, but it must be, the procedure must be the same. Okay, that's what I'm saying. Okay, number 8, going concern issue, I already discussed this one. Number 9, comprehensive income. Entity are required to present all item income and expense recognized in the period in a single statement of comprehensive income or 2 separate statements. Okay, this principle is talking about income statement. You know that when we prepare income statement, we have to make sure that we record income and expense for that period only. Okay, if we are talking about 2024, all income and expense that we are recording must be for this year. For next year are excluded. For last year are excluded from income statement. Okay, then number 10, statement of cash flow. Entity are required to disclose information about their cash flow from operating, investing and financial activities through the statement of cash flow. So when we prepare a cash flow statement, obviously we need to show that this is operating activity, this cash has received or paid from investing activity, this cash is from financing activity. We cannot just say that we received 20 million without showing that this 20 million is from loan, from financial activity. You must disclose that. So this is what it is all about. IAS.1, presentation of financial statement. I hope if you understand this basic, it can be at least more better for you to go through some kind of questions. So I hope you enjoy this video. Please make sure that you like and subscribe to this channel. I'm gonna see you on the other video or other standard. You can just check on the playlist of IFRS and International Accounting Standard. See you on the next one.